Hello, everyone, and a very warm welcome to today's major markets update for Friday, May the 26th, 2023. Only price pays. That's the only thing that matters. Everything else is secondary, tertiary, quaternary levels of interest. Price is the final arbiter, and that's the only one we trade. And everything else is an additional layer of evidence we use to analyze the market. Up is up, even on bad breath, etc. We have to respect price. So let's have a look, and I'll get back to this in a moment on why it is important to respect price and not get hung up, even though things are really bad under the hood. So despite all this bad breath, sell signals, price continues to march higher. This must be respected because only price pays our bills. It's our final arbiter. So price is always level numero uno. Market breadth is level 2. Sentiment, level 3. Seasonality, level 4. A little bit interchangeable, but it shows you where the focus lies. Everything is important in the market. Every single item, but in the end, price is always the most important. End of story. That said, NASDAQ is still on track for 30,100. See no reason to change my tune. I think we're going to reach it, and then we're going to see if we're going to extend above it, yes or no. NASDAQ 100 is extending. Doesn't surprise me. It did after revising the wave count to the largest 3, 4. A picture perfect 1, a picture perfect 2, picture perfect 3, picture perfect 4. And then often the market decides to throw a curveball and do a extended fifth wave. So the next upside target is 14,425, 14,775. We must break below Wednesday's low for all indexes, essentially, to suggest the top is in place. I think for the Dow and the IWM, it is yesterday's low. The semiconductors are in a wave 3, and they're going to target around 36.75. I think the semiconductors are still in a bull market, a larger final fifth wave to complete a supercycle 3 top. The monthly chart will soon have massive negative divergence, and that is something to be respected. The S&P 500 should still ideally target 43.15, 43.70, in my humble opinion, in overlapping fashion, as we are, in my humble opinion, a ending diagonal with 5. That said, Wednesday's low at 41.04 must hold going forward. All right, Dow Jones, bottom exactly where and when it had to. The 62% retrace, May the 25th. It should now rally into early June. Sorry, not May, but June. June. IWM technically still range bound, must break above 180 to target 190. Market breadth is still, unfortunately, LA classes have full. See the first sentence. However, it's level 2. It reminds me a bit of 2021 when mega cap tech was rallying like crazy and the small caps are already going sideways. Small caps are much more economically sensitive than, of course, large tech. Seasonality has tech weakness after early June, and the Dow and the S&P 500 strong into mid-June. Sentiment is neutral, so that one can still allow for higher prices, assuming, of course, sentiment is a contrarian indicator. Going to the big picture, remember, we are in this wave C of B, and then the rest will follow. I see no reason to change my tune. All the important price patterns, and here we go to the charts. So let's start off with the regular NASDAQ. Massive candle today after 2 doji candles on Wednesday and on Thursday. Ideal upside target, again, 13,100, potentially 13,200. Okay, we're going to start watching for negative divergences. Doesn't have to happen. And we can always extend. We start off with these CSA relationships, and then we can always extend. For now, it still looks better like only 3 waves higher. I don't see an impulse yet from the October lows, nor from the December lows. Remember, technology bottomed in December, pretty much at the same level as it did in October. And of course, the Dow Jones did quite the opposite. Oh, I don't have it. It rallied all the way, as you can see here, into December. So we're kind of seeing a reverse. When here in October, November, the Dow Jones rallied, technology did something meh. Remember this divergence. So bifurcated markets are nothing new. They have been a rule of thumb since pretty much the all-time highs were reached, except for 2022, definitely 2021. So please keep that in mind. NASDAQ 100, this is the hourly chart. As you can see here, wave 3, exactly 161.8. Wave 4, exactly 100%. Wave 5 should have topped here at 14,075. It looked A-okay, I would say, this morning. Again, it failed. Now, I haven't said a single word about shorting, inverse ETFs, none of it, none of it, none of it. If I say take appropriate measures, it means raising stop, taking partial profits. There's no reason to short anything, in my own opinion, unless we go below Wednesday's low. That is now the line in the sand. Fifth waves can always extend. This is typical. Wave 1, wave 2 did what they had to. 3 and 4 did what they had to. Wave 5 is extending beyond the topping zone. It's fine. We're extremely overbought, extremely, extremely overbought. This is a classic, in my opinion, fifth wave setup as well in the MACD. So please be aware that I think the risk is going to go a little bit more to the downside than to the upside. But we can target, as said, 14,400 to 14,700. Not a problem. If we're going to look at seasonality, we are here. So we are now in this blow-off phase into early June. Okay, it is today the 26th. Markets will be closed on Monday the 29th. So there will be no update on the 29th. Obviously not, there's nothing to update about. That then brings me to how much time is left for the markets to rally. Not so much, as you can see. It's getting pretty close, maybe another week. And that should be about it. And then we're going to go into a dry spell, at least for technology, as you can see, before we get maybe another gasp at it to be determined. But this is looking pretty good. As you can see, a strong rally from about May 23 into early June. Okay, strong rally from about May 23. So this was May 24. Strong rally. So how are we doing on the Dow Jones? The Dow Jones so far did a 62% retrace of this rally. This rally still looks better like an impulse. We need to get back above 33,800 to signal that the decline is over. We held the 200-day moving average. Back above the 50-day would also be great. Definitely some nice divergences going on the indicators. And we bottomed exactly where we had to on the timing frame. On average, 126 years of data, May 25th. And then again, a pretty strong rally into mid-June. Okay, so technology is going to top out early June, and the Dow might not top out until a week later. Then a weakness, and then a rally one more time. So maybe 1, 2, 3, 4, and 5. 1, 2, 3, 4, and 5 looks pretty good. So as long as we hold yesterday's low, we can move higher. Semiconductors, what a move! All right. All based, of course, on artificial intelligence. I'm afraid that it's going to go the same way as we've seen with all these things before. It's going to disappoint. Maybe regulations are going to come up. There's a lot of course, assumptions, but it seems very hypey, especially if Microsoft is going to get involved in AI. If Microsoft cannot even keep its Wi-Fi drivers on software use and just deletes them, I wonder what's going to do to AI. So always be aware. Regardless, we now need to go below. We have some big gaps filling in here. We now need to go below 32, 36. All right. So erase our stops, so to say. That is the appropriate steps to take. So next target 36.70 something. 3, 4, and 5. That's what I'm looking for. And then we can see if we're going to get 1, 2, 3, 4, and 5 higher. Yes or no? I think so, as it looks better with a very big fourth wave, because I can't count 5 waves up from the 2019 low. 1, 2, 1, 2, 3, 4, 1, 2, 3, 4, 3, 4, and 5. Larger 3, larger 4. Larger 4 should have ideally bottomed here, but doesn't have to. Again, that is what we normally expect. Doesn't have to, but we have no overlap with this wave 1, and we can now move higher. Look at this blue line that I've had on this chart forever, many months, and we got it much more extreme than this. So of course we want to see something like this, and what we're going to get now is like this and something like this. So we're going to see massive divergence happening on the MACD. We're going to get it something like this. This is the monthly chart, by the way, right? This is the monthly chart. And that would signal also weakness, meaning less strength. So somewhere around 4,500 looks like an ideal top for this. Cycle 3 or super cycle 3 doesn't really matter, as we then will revisit the 2020 lows in quite rapid fashion. S&P 500, how are we doing? This was the preferred wave count that we adjusted to a 3-4-3-4, ABC higher for 1, ABC lower for 2. We should now be in 3, 4, and 5 into the 43.15, 43.70 target zone. That would be about a 62% retrace, retest the August highs of 2022. This is the preferred path. I see no reason to change my tune unless we go, of course, below 41.04. This is then the hourly chart, also looks good. Remember, wave 3 in green is, of course, the same as wave 3 here in gray. It's just a different degree, potato, potato, and wave 3 should be in an overlapping fashion. So far, so good. We're getting quite overbought, so some pullback might not be unexpected. How would that match then with seasonality? Yeah, we could see a little bit more weakness early next week before we do the real blast off. So we're going to get an A, B, C. So we're kind of back on track again with seasonality. As you can see here, S&P 500 was supposed to bottom May 25, and of course we bottomed May 24. So not too bad. How are we doing on the Russell 2000/IWM? Well, it's back above the 50-day, but it's below resistance. It needs to get above 180, and then I think we can target somewhere around 190, make it 188, 192, somewhere around there. So not giving up on this one just yet. There's definitely a lot of positive divergence going on. So remember, we might start to see this sector rotation, that we're moving out of big tech into maybe now small cap. Seems like with quantitative tightening, there's only a limited amount of money available. So we have to be careful on where we put it, because there is simply not enough for all indexes, it seems like. Anyway, so we have also here continued strength. As you can see here, this still looks pretty good. Also here, this also looks good. These are all pointing higher, and this also looks pretty good. Money keeps flowing into the small caps, as you can see. Well, it hasn't gone anywhere. Now we need to see price break out. We need to break out above resistance on a closing basis, which we haven't done since March. Okay, we have not closed above resistance. Here we closed right at it. I think it was like 2 cents below it every single time. Here maybe 2 cents above it. All right. Okay, one swallow doesn't make a summer yet. So above 180, which is the 200-day moving average, which is 179.33 and declining. And I think we can target 188 plus minus 2. Now, how about that price only pays? And this is an interesting tweet by Walter Diemer from yesterday. Believe it or not, yesterday was a 68% downside day, while the S&P 500 was up 1%. The down volume over up volume was also much higher on the NASDAQ. And I thought it was a great quote. He said, it's obviously a Buffalo Springfield market. Something's happening here. What it is ain't exactly clear. So as you can see, if you would only focus on market breadth, you would get a completely wrong picture. That's why we always look at price first. But we must take this into consideration. And again, these type of conditions can always correct themselves. It's a condition. It's not a trigger, but it's something we need to note. It did wrong foot us 2 weeks ago as well, but it continues. This bad breath continues. Maybe it's going to get all erased, but it should have done it by now, in my humble opinion. So we're going to look here at the bullish percent index charts. It keeps rising a little bit for the NASDAQ 100. NASDAQ. But as you can see, still only 40% of all the stocks in the NASDAQ are on a pointed figure chart buy signal. Not 70%. So this is still not the hallmark of a raging bull market. Still not. It must be respected until proven otherwise. So this is guilty until proven innocent. How are we doing for the S&P 500? Only 47% of all the chart stocks in the S&P 500 are on pointed figure buy signal. So this one is still guilty until proven otherwise. This is still pathetic. But We respect price, and we have our price targets and our cutoffs, but this is giving us a warning sign. But again, divergence can last for a long time, so please keep it in mind. How we're doing on AD line for the NYSE. AD line is not making new uptrend highs either. It is still below its, I believe, February top. So this one is still also showing that we're not in a breath-leading market, where this is what we want to see, right? Price moving higher and the AD line making higher highs as well. Until, of course, you see something like here in November and January. This is this negative divergence. And what did we get here? This can always get rectified. Won't take too much, but so far we're making lower highs continuously and lower lows. How we're doing on the new news, also this one is still too high. Remains above 50. This is not the final data yet for the NYSE. It's at 70 currently, and 101 for the NASDAQ. It remains too high. So that is also a warning sign, but it's been on a warning for quite a while. So we have to note it, but for now ignore it, so to say, because price base and it's moving higher. But it's something to take into consideration, and it will help explain once we do top. How we're doing on the summation index, it's still negative for the S&P 500. But that then gives us upside potential, as the summation index now has time to move higher. What I would like to see, and this is of course wishful thinking, is negative divergence. Okay, so we'll see negative divergence on the summation indexes. So the market will move higher, but the summation index will make a lower high, similar to what we had here, and this will continue. So then we have pretty much double negative divergence on strength, and potentially negative divergence on the summation index. Okay, again, you can see the summation index has not confirmed a buy signal whatsoever. Can take a while, as you can see here, a couple of weeks, sometimes 3 weeks before we get a buy signal. That's okay, but please take this into consideration that so far we don't have any confirmation yet of this rally, not yet. But again, price base, and we're moving higher. So also this one doesn't give you a more fuzzy feeling, so to say. I need to see much higher readings. But again, I respect price. How are we doing on the PMO? It remains on a sell. Weird, huh? Everything is pretty much against the market. So I don't have data for today yet. If we're going to get a buy signal, meaning a up candle, which is open and pointing up, then we have a non-ideal bottom in place. But it's been on a sell for 2 days, interestingly enough. While everything seems to rally, well, mostly tech and semiconductors, this one has been on a sell. Why? Because the NYSE was down. The S&P 500 is pretty much down over the last 2 days. Russell 2000, Dow Jones. So most indexes were actually not faring so well. And that all needs to be respected. We keep that in our back pocket, but we don't trade off it. That's the whole point. We don't trade off it until proven otherwise by price. Last but not least, how are we doing on sentiment? Well, our active money managers are still a little bit underexposed to the market. This is data going back to yesterday. I don't have, of course, data today. That will become available next Thursday. So maybe we get overexposure, but for now, we're not overexposed. As you can see here, once we get overexposed, we often get down. We're not overexposed. We're below the long-term allocation average. And as you can see, the long-term allocation average is declining. It's not really increasing. So on average, the long-term trend is, for allocation by active money managers. How we're doing by individual investors, AAII sentiment survey from yesterday shows about 27.5% bullish and about 40% bearish, a little bit less neutral. So we've definitely moved a little bit more towards the bullish camp. The average is 37.5, 31, 31. So this is noise. This is about average. This is mediocre, so to say. AAII has done studies themselves, and you have to have readings that are 2 standard deviations away from the mean to really be meaningful. Everything else is noise, according to them, where you have more hit and miss from a contrarian point of view. So here, this was quite extreme on the 17th last week, quite extreme. Then we're two standard deviations away, and so it's no surprise that all those people that were not bullish are now being wrong-footed and told they were wrong and should have been bullish. And now we're moving towards, again, more of an average, so we can't say too much about the sentiment. Same here, of course, with the money managers, still a little bit below average, but that's about it. So that's really all I have for this week. Please remember, there will be no update on Monday. Please remember, only price base. So as long as we're going to hold this week's lows, we can allow for the indexes to extend, reach the upside targets, and potentially complete a much larger bull market for the semiconductors. I still don't see it for the Dow. I don't see it for the IWM. I don't even see it for the NASDAQ 100, potentially. Definitely not for the NASDAQ, but also not for the S&P 500. Everything else seems pretty much on track. The only thing that seems to be happening right now is some extensions going on. That I think is a luxury problem to have. Market breadth, still glass of half full, as I showed you. It's still a glass half full. Seasonality shows the tech should be weak after early June, and the Dow and S&P 500 should be strong into mid-June. We might see a little bit of weakness early next week. Wouldn't surprise me to get rid of some of these extreme overbought conditions on the shorter term. And sentiment, as I showed you, neutral. Take care, trade safe. No update on Monday, and I'll catch you all next week. Have a great week and enjoy your time off. Bye.